Hi, welcome to our first video newsletter. We send out our monthly commentary to you, but we thought this time we would try a short video presentation to summarise the key issues. The focus of our discussion today is going to be about the various economies and relating this back to where we see the long-term returns of the share markets. First of all, Australia. As you'd be aware, the RBA cut interest rates last Tuesday to 2.5%, which is a record low. The RBA usually cut interest rates to stimulate the economy and is clearly concerned about long-term growth. We have ridden the mining boom for a long time in this country, and other sectors of the economy appear to be struggling, and that is what the Reserve Bank are targeting. Lower interest rates are generally good for shares for two reasons. Number one, companies have lower borrowing costs so they can make more profit, and number two, returns from other investments such as term deposits are less attractive as compared to the dividends from shares. So referring to the tipping points chart below, Australian shares we believe are in the cheap range, and we expect long-term returns of between 10 and 11%. Turning our attention to US and Europe, regular readers will know that our view is that US and Europe are on a slow, stumbling road to economic recovery following the GFC. In America, interest rates are effectively at 0% and can't be cut any further to stimulate the economy. Housing prices have recovered a bit, but employment rates are very flat. Meanwhile, the share markets in America are at pre-GFC highs. The market is fully priced, and we expect returns for there to be only around 5% going forward. Having said that, there will be some companies within the US share market which represent good value, and any exposure there will be focused on those companies. In Europe, the situation is worse. Unemployment is at 12%, and Greece and Spain is at 27%. It's been relatively quiet there over the summer holidays, but we expect more bad news to come from there. We then move to emerging markets, and this is dominated by China, Taiwan, and some other countries such as Brazil and India. There's been much discussion about the slowdown in the rate of construction and growth in China, which has got a flow-on effect to demand for our resources. And it is true that the Chinese economy will turn from relying on imports largely to more an internal focus on goods and services as the middle class rises up. However, there is still a long way to go. The emerging markets do not have the high debt issues that the developed economies have in Europe and America, and we think that growth there is likely to be better. Of course, due to the nature of these markets, the share market returns will come with high risks and are likely to be more volatile. Still, as a whole, we see these markets as providing attractive future returns. And if you refer to the third column there, you'll see that our expected returns for emerging markets are between 10 and 11%. Finally, property, which is the final column on the right. In this regard, we're talking about listed property trusts, which are the big owners of commercial and retail properties. Some of the biggest name there is Westfield, which, as you know, is the biggest shopping centre owner in Australia. Others such as Stockland as well. So listed property trusts were absolutely savage in the GFC, but have recently had a very good run. We see them in the fair value to fully priced range, and expected return of between 6.5% and 7.5%. Obviously, this does not include residential property, which I know many of you are interested in, but we will discuss that in another webinar. Thank you.